Probability of a loss. We always talk about probability of profit. We never talk about probability of a loss.
This is true. That's true.
Okay. Probability of a loss. Let's take a look.
Let's do it.
When determining position size in a Tasty account, it's crucial that we look at two key factors: probability of profit and the correlations of the underlying to the current positions. We always look at probability of profit, correlations of underlyings to current positions. That's kind of a natural thing. It's not something that we wouldn't say we're not going to make this trade because it's too highly correlated, but we are cognizant of what our positions look like. That's right. It's not, we're not specifically going to say we're not going to make a trade just because we have other positions.
Wouldn't you want to do something that it was correlated in so that you got the delta that you wanted, either the reduction?
No, I want to keep pretty good diversification, but I'm not going to not make a trade just because it's highly correlated. I'm just going to make sure overall my positions are pretty much non-correlated. Let's go to the next slide. Just to add a lot of different things.
No. Your positions are non-correlated, but when you need to make a change.
Oh, sure.
Okay, that's what I was saying.
There's typically a trade-off between pop and max profit potential. The higher the pop trades, that's probability of profit, should be allotted a larger portion of your portfolio relative to low pop trades. Mm-hmm. And that's the way we've approached trading since the beginning of Tasty. You want to do things that have a 50-50 shot or worse, like buying some out of the money, call some, go right ahead. But allocate more money towards your high pop trades. So what we looked at here is, we wrote here, you can see a 16 Delta Strangle has a 68% pop. That's theoretical. And a Straddle has a 50% pop. That's theoretical. And you can see potentially a greater max profit. But let's see. Next slide, please. But assuming independent occurrences in uncorrelated underlying, so the same thing doesn't happen over and over, the larger the pop, the smaller the chance of multiple losses. See, when things are going good, everything's kind of easy. But when things are going bad, everything gets kind of rough if everything's highly correlated. And if you have that 67%, that which is just the theoretical number, it's actually much greater than that, your chances of having consecutive losses in a row go way down compared to 50-50 shots or below.
Sure.
If you're going to buy a lot of out of the money options, the risk of it is not that you're going to that you necessarily have a bad pop. It's just that there's a very high chance of lots of consecutive losses, and those are hard to make back. Mm-hmm. And you can see it here. This is what we love. We love this slide because 50-50, 1 and 2, but 67.5, 1 and 3. Okay, it makes it just more interesting. You're not going to do 95%, but whatever. Let's go next slide. So what we have here is the probability of all losers, and this is with the number of trades. It's the same thing you just saw on the last slide, but we laid it out in graphical form so you can kind of see it. 25% pop, 50, 67.5, 75, and 95. It's quite the different animal. And anyway, you can kind of get it's a good visual. Let's go next slide. So when trades are in highly correlated underlyings, there's no diversification benefits since they're essentially the same trade from a risk perspective. Like if you do something in the S&Ps, the NASDAQ, and the Russell, and you do the same trade in all three, you're kind of going to have the same result.
Sure. I mean, they're highly correlated. I mean, we'll say 90, but it's 80 then, you know what I mean? Maybe in a shorter time frame, it's not as correlated as it normally is over a much longer time frame, but I'd bet on it being correlated.
So this is kind of a cool stat here. 3 trades, each with a 70% probability of success. And if they're uncorrelated, okay, the probability of all 3 being losers is 0.27. If they're correlated, it's 30%. Hence the argument for non-correlated or uncorrelated trades. Again, this is the thing that a lot of people pay a lot of money for. In other words, one of the reasons they use a lot of outside services, money managers, things like that, is that they're supposed to understand how these statistics work. But this is quite interesting. 3 trades, each with a 70% probability of success. If they're uncorrelated, the chance of all 3 being losers is only 2.7%. If they are all correlated, then it's a 30% chance. There's your argument right there.
Awesome.
Let's go to the next slide. And then loading up on SPY and diamond trades doesn't provide the benefits we'd expect from trading different underlyings. Low correlated underlyings provide true, or non-correlated underlyings provide true diversification. So we had a little fun here with using the US dollar versus the S&P 500 and the Dow versus the S&P 500. In one case, the correlation's almost perfect, 0.92. In the other case, it's a negative 0.09. So when you do straddles in both, the probability of losing on both is only 25% if you do the non-correlated ones. And if you do 16 delta strangles and you only have 2 trades on, it's 10% versus 32%. It's just the argument, it's the mathematical / theoretical argument for being non-correlated. Mm-hmm. And that changes kind of, that you want to eliminate losses, that eliminates your probability of a loss. That's all it is. Nope.
There's 2 more after this.
Oh, there's 2 more.
Slide 7.
Oh, okay. There's a lot.
2 cloud.
So TLT strangles hit 2 times and 3 times losses more often than SPY due to lower initial credits. However, it's fairly rare for the SPY and TLT strangles to incur losses, particularly large ones. For example, SPY strangles and TLT strangles have lost more than 2 times the initial credit, 6% and 9% of the time, respectively. So another thing that we're looking at here is if you have these lower vol indices, what are the chances of losing, a significant amount? And it's pretty interesting here, but the probability of a loss worse than, and let's say half of 1x, or 50% of 1x, only 14% or 15%. 1x is 13. These numbers seem really low.
They do seem low.
I mean, really low. Because I got a Q trade on, which definitely is more than 2x loss.
And TLT has a dividend today, just to mention that too, since it's up there.
Yeah, we don't really have a.
I know, but other people do.
It's if you're short and deep in the money call in TLT, but I don't think anybody's going to be short deep in the money calls because it's on its butt.
Lows, yeah.
Yeah. Mm-hmm. So I don't think that'll be a problem. But these are really interesting stats here of probability of a loss worse than 3x the credit received. In the SPY, it's only 3.5%. TLT is only 7%. Oh, this is a good one too. If a SPY strangle incurs over a 2 times loss, a TLT strangle does so 30% of the time. Larger SPY losses increase the likelihood of significant TLT losses due to market volatility. So managing position size is the key to reducing the risk of simultaneous large losses. I liked this because it was kind of fun. So the probability of a TLT strangle loss worse than X, given that the SPY strangle is worse than X. And it just kind of goes down the line and shows you, that when volatility goes up, it's pretty hard you can't fully protect yourself when volatility goes higher. Mm-hmm. And when the markets have big moves. But, being diversified can help a lot. Higher volatility is just going to be higher volatility. Being
diversified is harder than you think, too, because a lot of stocks move in the same direction.
Yeah, it's hard.
Yep.
So some of the takeaways. High probability profit trades exponentially reduce the chances of multiple consecutive losses. You want to be up in that 70 range because it really reduces the chances of multiple losses. We should allocate higher pop trades to a larger portion of our portfolio relative to low pop trades. That's kind of common sense-ish. To benefit from diversification, we must trade underlyings with a low correlation to each other. Otherwise, it's essentially the same trade. And while diversification is crucial, position sizes must also be kept small to protect from market-wide volatility. Just what we saw on the last slide. Even if bonds and stocks are diversified from one another, if you trade too big, you're going to be subject to the risk of volatility expansion. It's a good piece. There's a lot in there.
A lot in there. Good job, Eddie. You saw them. We're going to take a quick 90-second break and come back. We got more Tasty Live with the opening bell next. Be back in 90 seconds with Tasty Live.